Every candlestick on your chart is a tiny story of a market battle. Most traders glance at them and only see colors. But if you learn to read them, you'll understand exactly who is winning between buyers and sellers, and you'll see big moves forming before the crowd even reacts. In this masterclass, we'll break everything down to 3 powerful candle types: strength candles, control shift candles, and indecision candles. And we'll work through real live examples to show how these 3 types repeat across every market and every time frame. By the end of this video, you'll have a complete candlestick playbook you can apply tomorrow. Now, before getting into the video, let me introduce you to the DTC TradingView Strategy. This is the same strategy that recently pulled in over $25,000 profit across the top 7 pairs in a single week. If you want your TradingView charts to look like this and receive clean trade alerts in real time, check out the details inside our free Telegram channel. The link is in the description. It's the best way to see the setups we're running live every day and decide if you want to take your trading to the next level. The market is always an auction between buyers and sellers. A strength candle captures the moment when one side totally dominates the auction. Imagine a candle with a fat body and barely any wick on the resisted side. If it's bullish, that means buyers were in charge from open to close. Sellers barely got a chance to push back. Reverse it for bearish. A wide body closing at the lows, almost no lower wick, tells you sellers were in total control. Now, not every big candle is equal. A giant candle with 0 wick is the loudest signal possible, but even small wicks matter. A candle with a tiny upper wick still shows clean, uninterrupted buying. A candle with a big upper wick? That's not true strength. It means sellers forced a pullback before the close. Consider size as well. A big, no-wick candle covering the day's range tells us there was a surge of real orders, not just random volatility. A small no-wick candle might look neat, but has far less meaning because the distance traveled is small. Think of it like a car race. It's not just whether one driver stayed ahead. It's also how far and how fast they pulled away. One of the most famous strength formations is the engulfing candle. Imagine 4 hours of small bullish candles that slowly push price higher. Then, in one single hour, a single bearish candle erases all of that gain. That one candle achieved in 1 hour what buyers failed to achieve in 4. That's pure control in action. Strength candles are so important because trends are literally built out of them. A strong uptrend is nothing more than a staircase of bullish strength candles, occasionally interrupted by shallow pullbacks. A strong downtrend is the mirror image. To master this, study how strength candles look on different time frames. On the 5-minute chart, they might be a fast surge caused by intraday order flow. On the daily chart, they can represent an entire institutional buying spree. Zooming in and out helps you judge whether a move is a tiny blip or the start of a bigger campaign. And don't forget multi-candle momentum. If price runs 100 pips in 1 hour and needs 4 days to drift back to the starting point, buyers are far stronger than sellers even if price ends up at the same level. That speed difference is pure market information you can only see if you read candles as a timeline, not just as isolated patterns. Key takeaways. Trade with strength. If strength candles tell us who's winning, control shift candles tell us when the winner is about to change. Picture a candle that opens. Buyers drive price way up, and then sellers slam it back down so it closes near or even below the open. The long upper wick is not decoration. It's the story. Buyers had control early, but completely lost it by the close. The opposite is true for a bullish control shift. Sellers push price sharply lower, but buyers step in and force a close near or above the open, leaving a long lower wick. Whether the final candle is green or red doesn't matter. What matters is that single decisive wick showing who finally controlled the close. Classic pin bars are simply control shift candles with a fancy name. What matters is not memorizing patterns, but understanding the psychology. Someone tried to take the market somewhere and failed. Location is key. A control shift candle in the middle of a random range doesn't mean much, but if it forms at a strong resistance level, at the top of a mature uptrend, or inside a key supply or demand zone, it can be your first high-quality reversal signal. Dig deeper and you'll notice that some of the best swing highs and swing lows are formed by a series of control shift candles, not just one. For example, 3 consecutive long wick rejections on a daily chart often precede a major multi-week reversal. Watching how these candles cluster gives you even more confidence in the story. You can use them in multiple ways. entering a reversal trade directly at the close of a clean control shift candle, waiting for a break of minor structure and entering on the retest, combining with higher time frame strength candles to ride a full trend change. Mastering control shift candles is like learning to read the market's turning signals before everyone else hits the brakes. The third major type is the indecision candle, where buyers and sellers are perfectly matched. It has a small body and roughly equal wicks on both sides. Indecision itself is not something to trade. It's like the market putting up a pause sign. But that pause contains valuable clues. At major highs or lows, a cluster of indecision candles means the side that was in charge is losing momentum. At the midpoint of a strong trend, indecision can mean accumulation or distribution, a quiet buildup before the next breakout. You'll see many variations: classic doji, long-legged doji, spinning tops. The exact shape doesn't matter. What matters is the story. Equal attempts to go higher and lower with no resolution. Trading with indecision means trading after it. Wait for a strong candle to break out of the range. The first clean pullback into that indecision area often becomes your entry zone. That's where smart money often adds to their position. Indecision candles also mark demand and supply footprints. If you see an indecision candle followed by a big strength candle, mark that area. Institutions were likely active there. When price comes back later, it often reacts again. Now let's put everything together with a full live chart walkthrough and more than one example, so you can see how the story repeats. Imagine a market that begins with a series of bullish strength candles. Buyers are clearly in control. Over the next several days, price drifts lower in a slow, overlapping fashion. It takes 4 days to give back what buyers gained in just 1 hour. That time imbalance screams that sellers are weak. Price eventually revisits a demand zone. Inside that zone, you spot a perfect control shift candle with a deep lower wick rejecting new lows. A few candles later, a big strength candle blasts above recent highs, confirming that buyers have regained dominance. That is a textbook buy setup: demand zone, control shift, strength confirmation. Now let's layer in multiple markets and time frames. Example 2. On a 5-minute chart during the New York session, you first see the market moving in a bearish trend. Suddenly, a large bullish strength candle breaks the range, followed by a quick control shift pullback with a long lower wick. The two very next candles are clean strength bars to the upside. This combination gives you a surgical scalp trade with a tight stop and a strong risk-reward. Quick break here. If you're serious about trading and want to reach the next level, we've got you covered. The DTC TradingView Strategy has already generated $25,000 plus in profit across the top 7 pairs in just the last week. Our daily trading signals are also delivering great results. If you want your own chart to look like this and get trade alerts whenever trades happen, you can join either of our services. More details are inside our free Telegram channel. Link in the description. Check it out, see the setups we're running live every day. Now let's get back into the masterclass. Now let's turn these observations into a complete, repeatable trade plan. Step 1. Identify key zones. Start with the higher time frame, 4-hour or daily, to mark supply and demand levels. Look for spots where indecision candles were immediately followed by strong strength candles. Those are institutional footprints where big players entered aggressively. Then drill down to the 15-minute or 5-minute chart to fine-tune the level. Multiple time frame alignment means you're stacking the odds. Step 2. Wait for control shift confirmation. Don't jump in when price first touches the zone. Wait for a clear control shift candle, a long wick rejection or classic pin bar that proves the other side just lost the fight. For even higher accuracy, demand a micro break of structure on a lower time frame. This extra patience filters out many fakeouts. Step 3. Enter on strength. Enter on the first clean strength candle that closes past structure. This candle is your green light. It shows that not only have the defenders failed, but fresh capital is committed in your direction. Step 4. Smart stops and targets. Your stop belongs beyond the zone, not at a random pip count. Use either. A fixed risk-reward multiple, like 1 to 2.5 or 1 to 3, or natural market structure, recent swing highs, lows, or next major zone. You can scale out partial profits at 1 to 1 to reduce risk while leaving a runner for bigger moves. Step 5. Position sizing and portfolio control. Risk a fixed percentage of capital, usually 1 to 2%. Calculate position size based on account size, stop distance, and risk percentage so every trade risks the same amount of money, not the same number of pips. Cap total open risk across all trades at a maximum, for example 5%, to avoid hidden correlation blowups. Step 6. Manage the trade in real time. Once you're in, the chart keeps talking. If you see multiple control shift candles forming against you, consider tightening stops or taking partial profits. If fresh strength candles keep forming with the trend, trail your stop just below each new higher low or above each new lower high. Step 7. Scale up with proof. Only increase position size after you've logged at least 50 trades with a positive edge. Scale using profits, not new deposits. Professionals grow slowly but last for years. Even the cleanest setups fail. That's normal. What keeps you in the game is risk discipline and mental conditioning. Risk management. Fixed, fractional risk. Never risk more than 1 to 2% of account equity on a single trade. Predefined stop. Place it beyond the true invalidation level, where your original trade idea is proven wrong. Dynamic portfolio cap. Never have more than 5% of capital at risk across all open trades. Treat these numbers as unbreakable. Risk is the one variable you fully control. Mindset and process. Think in series, not singles. Judge performance after at least 20 to 50 trades, not 1 or 2. Journal every trade. Screenshot entries, exits, and all 3 candle types involved. Over weeks, you'll start spotting personal tendencies, both strengths and weaknesses. Train patience. Use TradingView Replay to watch historical price action unfold 1 candle at a time. Pause, predict, reveal. This builds pattern recognition muscle without risking capital. Self-management habits. Trading is as much about mental stamina as strategy. Before each session, spend 5 minutes breathing or meditating to clear noise. Review your written plan. Decide on your maximum number of trades for the day. This structure keeps you from revenge trading or chasing random setups. By combining tight risk limits with a calm mind and a crystal-clear candlestick framework, you move from hobbyist to professional, someone who can survive any single loss and stay consistent for years. Every candlestick is a message from the market. Strength shows domination. Control shift signals a power change. Indecision reveals the pause before the next move. Master these 3 and you'll trade with the market, not against it. Before you click away, one last reminder. If you want to see how I combine these concepts with automation, check out the DTC TradingView Strategy and Daily Signals service. Both are explained and updated inside our free Telegram channel, link below. You'll see live trades results, equity curves, and every setup we're running day by day. If you found this masterclass valuable, hit like, comment Candle Masterclass so I know you stayed till the end, and subscribe so you never miss a full market breakdown. Thanks for watching. And remember, every candle is telling a story. Read the story, trade with the flow, and stay on the right side of the market.